So what we have left, so probably what we have is, so I'm gonna do this today, okay, and I will do a little bit of that on Monday, okay. So hopefully we'll be done by Monday on this, and then you'll be tool up so that you can prepare. I need to talk to so that we can prepare for whatever whichever we want we do with the M&A simulation or the other case, okay. The spin-off, the eBay, whichever one we do, you're gonna need some valuations, okay, to do the case. So that should be fine for April, okay. So when I come back in April.
Yeah.
Obviously, valuation is central also for when we're trying to do mergers and acquisitions. The handles of mergers and acquisitions and restructuring and so on and so forth. Sure. Okay, so let's get going. Okay. No questions about everything, the previous anything, nothing, crystal clear. Okay, so you're all clear for the case of Samsung on Monday. Okay.
I was gonna ask about the Samsung case. When you said we needed the corporate ownership around the world paper to
I said you should read it. Yeah.
But do you expect something similar, like a similar analysis to what you did for Samsung?
No, I think it gives you some idea about, lets you understand a little bit the case, and it gives you some tools probably to answer some cases of the, some questions of the case, okay? But that paper, but also the whole handout, in general, but that paper is particularly important to give context to the case, I think, okay?
Yeah, I do have a question on the last handout. On the last part that you explained on the one vote, you put three methods, right? One vote, one share.
One share, one vote. Okay, so one share, one vote would be the ideal. Okay, one share, one vote is everybody votes how much money that you put in. So that's the idea. And then we said there's deviations from one share, one vote.
Okay. Those two are the ones that I understood that's where you get to the pyramid.
Okay, so the pyramid is a deviation from one share, one vote. Okay.
Okay. So in that scenario, so how does it work? So if it's not one share, one vote, then what is?
It is one share, one vote, but the structure of the pyramid ends up giving you a deviation from one share, one vote.
Based on the math that we did.
Yeah. So you can combine. So basically, because based on the math that you did. So in the end, since you control every company, you don't need to control it with 100%. If you control it with 100%, then you would be back to one share, one vote. But since there's, since you're moving in the chain and you're controlling with less than 100%, then that's immediately starts taking you away from the one share, one vote. Okay?
And then there was a third one, right?
That's no. The one share, one vote is the method. Then there's three main deviations. Okay? One of them is going to be pyramids, which gives you that. The second one is multiple voting, okay, or non-voting shares, right? So if some shares have multiple votes, then it's not one share, one vote. So you can issue shares that have one share, one vote, or you can issue shares that have 2 or 3 votes, okay, or shares that have 0.001 votes. Okay, so in Sweden you can find all kinds of shares, for example. So shares that have 0.001 votes, shares that have 1,000 votes, shares that have, et cetera, et cetera. Okay? So that's another deviation. That's a second deviation, which is multiple voting or non-voting shares. Okay? And the third deviation is the one that we talked about that says cross-shareholding. Okay? So cross-shareholding is a structure in which, so you have a series of firms, and then let's go to 3. Okay? So imagine that I have these 3 firms. Okay? So and this firm owns, 10% of this one, okay, and this one owns 10% of this one, okay, and this one, 10 and 10, okay, and 10 and 10, okay. So now, if you want to challenge control, okay, this is going to be very difficult, right? Because these 3 may vote together, okay. So it's still one share, one vote. But it's very difficult. So this one is always going to protect, these 3 are going to protect themselves. Okay? So you try to come from outside, okay, this is going to be very difficult because the guys already kind of arrangements together. okay? So that's kind of another deviation from one shareholder, cross shareholding. That's cross shareholdings, okay? So it's multiple voting, or non-voting, cross shareholdings, and pyramids. So there are three deviations. And in most animals, in those common animals, pyramids. We find pyramids everywhere, okay? Fine. Anything else? Okay, good. Fine. So let me get into valuation now. Okay? Okay, so let me give you another, this is what we're gonna do, or hopefully we're gonna do something. Why doesn't it work? My thing. Okay. Okay, so there's a mini handout and then there's a nice paper brothers handout, okay? Okay, so this mini handout will just give you the general concept of valuation, and then we're going to go through all the valuation methods that we have afterwards, okay? Okay, so first I'm going to talk about some general ideas, and then I'm going to try to understanding value, okay? In order to understand value, we're going to, do a little bit about what is the difference between economic value and book value, okay? And that's kind of like the basic of valuation, okay? So basically, behind every single thing that that a firm does or that should be doing should involve a valuation. Any decision that a firm takes should be involved in a valuation. Okay. Basically, it's anything that every time that you're trying to allocate resources to any part of the firm, you should try to figure out, if this is the best use of the resources. Okay. So if you wanna buy a company, well, clearly there's a valuation. If you want to launch a product, clearly there's a valuation. If you want to decide if you're going to do R&D, there's clearly a valuation. Deciding to open it up or expand on a brand or a subsidiary, that's clearly a valuation, et cetera, et cetera. Okay? So all of these things should involve, value the resources that you're putting to see how much you're going to get out of them. Okay? Now, it's not working very well. Okay. So as I was saying before, this is more or less the same thing, okay? So if you want to purchase a company, if you want to start a firm, okay, or if you want to evaluate a business, if you want to harvest a venture, all of these things involve these valuations, okay? Because we need to hear about operations, about opportunities, et cetera, okay? The most basic valuation problem is you want to value your own operations or the valuation of the assets that you have in place, okay? So often managers estimate, how much is worth the ongoing business, to figure out if they should expand it or not, or something like that, okay? So that's kind of what's simple as that. So the question here that we're going to follow is, here's the key, is how much, so in order to figure out the value of anything, okay, the key question or the key method that people use, that's probably the most, the one that gives you the best result, okay, is this idea of how much we're going to develop this concept, how much are worth the expected future cash flows, okay, once the company has made all the major discretionary investments, okay? So it basically means how much is the firm going to grow, how much is the project going to bring once I paid out all the costs, okay? That's basically what it means. And then we're going to try to get to the concept of this expected future cash flows a little later, okay? If you are a publicly traded company that is in the stock market, where you have a very good guide for valuation because the market is valuing the company all the time. So all the people in Wall Street do is try to figure out what's the value of a company, and that's the price of the shares, okay? So the price of the shares gives you what the markets are thinking is the value of the expected future cash flows that are going to bring, okay? Because all that the equity gets is the dividends, okay, or the value of the share. So basically that's the value of the project, okay? Now, if you're a publicly traded company, then you can get this value from the market. That doesn't mean that it's a perfect value, okay? Because markets, move, go back and forth, okay? They get excited, they get depressed, okay? Whatever, okay? Or they may not know everything, okay? So they may not get it right. Now, if you are a privately held firm, that's going to be very difficult because you do not have, Wall Street analysts trying to figure out your value, okay? So we're going to try to use the other methods. We're going to try to mimic the firm two similar firms in the market. Okay, so you're gonna try to get some idea about or your price from the prices of twins. Okay, let's call them twins. The better the twins, okay, the more similar the twins are, the better it's gonna be. But as we will see in the next paper products, this is not gonna be perfect, so you're gonna need to be doing some things. Okay. If a firm has a long history of financial accounts, well, that's great because you can figure out more or less how much the firm has been given, and a good predictor of the future, maybe the past. Okay, but if it's a new firm, so if you're a small, privately held, and a new firm, then it's going to be more difficult. Okay, still you're going to need to do it. Okay, so there's many methods that people have used. Okay, and that's what we're going to do there. Okay, so when do we do valuations? Okay. What do you value a business? This is like the top 10 uses of evaluation methods. Okay, so number 10, okay, when there's a problem at home. Okay, so when there's a problem at home, then you go to the lawyer and they say we need to split the thing. Okay, so now you need to value the thing. Okay, so you're going to be valuing all of the assets. Okay, so and this could be marital dissolutions at home or in a business. Okay, so people also fight and then they split. Okay. That's very important, okay? So this is number 9, business disputes, okay? So if there's a business dispute, typically people are going to say, well, either you buy me out or I buy you out, okay? So we need a value, okay? And then, obviously people come up with very different values on both sides of the aisle, right? A lot of this is going to have to do when you do taxes, okay? So you need to file, your state taxes, okay? And the value of, your assets, because you need to sort of pay taxes. Well, that involves a valuation, okay, as well. If you plan your estate, okay, so you want to figure out how much you're going to give to each of your kids, okay, well, you're probably going to need to do some valuation of the assets, okay, and this is how people actually use it, okay. If we're going to give gifts to your kids, okay, or gifts to anybody, okay, so then you also need to sort of try to do a valuation, you can see. If you plan to give shares to your employees, well, you better know how much you're giving them, okay? So these are employee stock ownership plans, or if you want to give them stock options and so on and so forth, okay? You need to have a value of the firm, okay? So that is also placed out. Number 4 is in any kind of buy and sell agreement, okay? Anytime you're going to buy and sell in an acquisition typically, okay? So you are going to need to have a valuation, okay? Number 3, if you want to purchase, okay, or sale the business, okay, just for fairness, so that you're sure that the others are getting the same, okay? So if you put it out something for sale, then you need to make sure that every shareholder gets the same, okay? So the valuation for which you're selling it, it's fair, okay? So that's what people are going to ask you, okay? Then if you're trying to get some financing, okay, you're going to need to show the bank a valuation, okay? Or anybody that wants to come in, it's going to be doing a value, okay? It's going to be doing a valuation before it gives you any financing, okay? So these are from 10 to 2, but the most important, these are all kind of driven by an event, okay? So there's an event and that triggers the valuation, okay? But the most important thing is the valuation. Firms should be actually valuing themselves all the time, okay? If you wanna figure out how well you're doing and where you should expand, where you should cut, etc., you need to be valuing the business all the time, okay? And this is something that people forget to do, but it's kind of very important to do. People do valuations once, okay? People do valuations, okay, when they need to, but in reality, the business should be valuing itself all the time. To try to figure out, there may be parts of the business that are, should go out, okay, because you don't profit from them enough, or there may be other ones that should be expanding, or you need to acquire more assets on, okay? So those are valuations, okay? So what is what I'm going to say? I don't want to say anything about that, okay? So misconceptions about valuation, okay? So misconception number 1, okay? A valuation is an objective search for the true value, okay? So people, you walk in the valuation, it says, fine, and I'm going to know what the true value is. Well, not clear, okay? All valuations are biased because they all make assumptions, okay? So the only question is how much they're biased and in which direction. So there's no true value, okay? You're gonna be putting a lot of assumptions in there, okay? We have multiple evaluation methods, and you wait to see, you hope to see that you converge to some kind of a value, but there's no true value, okay? And typically the direction and the magnitude of the bias in your evaluation is gonna be related to, which part of the transaction you have. Are you the buyer or the seller? Okay? So the seller always thinks that what he has or what she has is worth a ton, okay? And the buyer doesn't value it as much, okay? Just because, the seller gets attached and the buyer doesn't want to get attached, okay? So there's always going to be a bias, okay? Myth number 2, a good valuation provides a precise estimate of the value, okay? Well, not really, okay? There are not precise valuations, okay? It's not, physics, okay? It's not, molecular chemistry, okay? So it's going to have, as I said, many assumptions. But because there's no precise valuation, that's why this is important to do it. Because the payoff of the valuation is more important when the valuation is the least precise. What does that mean? That means that if you're really uncertain about value, this is when you should start valuing. Because if you don't value, then you're probably going to mess it up. Okay? So not because you're not going to get to a precise value, that doesn't mean that you shouldn't do it. In fact, when there's more uncertainty, that's when you should really do it. Okay? Because otherwise I may be wrong. Okay, and myth number 3, which is the economist myth, okay? The more quantitative the model, the better the valuation. Okay? So like we have in our minds, a lot of us have in our minds this idea about, you put all the parameters in, and then you shake it up, and then, and then here comes the best model, right? Well, the problem of that, putting everything in and you put it in, and shake it up and put it in the milk, create a milkshake, is that in valuation there's tons of assumptions, okay? And if you just throw everything in, then you do not know which assumption is driving the value. So it's not necessarily related to how quantitative the model is, okay? It's about how much you understand what's driving the model, okay? So the understanding of the valuation model so that you can move the parameters around is very valuable, okay? Because otherwise, if I just throw everything in and here comes the milkshake, and then it's worth 100, okay? Okay, but it's more or less, it's more or less, you need to understand and dissect the value, okay? So, in fact, the understanding of the evaluation of a model is really what is in the key, okay? So simple valuation models tend to do much better than complex valuation models because you can understand, okay, what people are assuming, and then therefore you can understand, where the bias is. And you can always switch it around and turn it around, okay? So it has to be malleable, okay? So that you can really move it around, okay? Precisely because there's no true value, okay? Is that clear? Fine, so those are my myths, okay? So as we said before, what is involved in the evaluation of a business? Well, everything, okay? So the background of the business is going to come in because that's going to be touching cash flows. The economic outlook is going to come in because that's going to determine future cash flows, okay? And, what is the industry and the competition? Well, that's clearly going to affect prices and therefore cash flows, okay? All the financials, well, that's clearly going to affect everything that you put in, okay? Comparisons across industry, comparisons within the company across time, expectations about the future. So the nature of the business, all of that is going to be, embedded in the cash flows, okay? So it's like it's a complex toy, okay? Fine. Is it clear? Mm-hmm. So that's the general idea that I want to pass. So now I want to talk about a little bit about this idea of the difference between book value and economic value, okay? So what's book value and economic value? So in our searches, we're trying to figure out what is the present value of the future cash flow. That's what we're trying to figure out because we're selling and buying, okay, our assets today, okay, but the assets are going to be generating value in the future. Okay, is that clear? Okay, fine. Obviously, there's going to be judgment and opinion. Okay, and very rarely, as I was saying before, the seller thinks that the same as the buyer. Okay, about the value of the firm. So this is going to be some. There's going to be disagreement. Okay, the buyers, all that they care about, okay, is the future cash flows. They really don't care about anything else. Okay, they don't care about how attached you are to your assets. It's worthless for them. Okay, so this is where we're going to need the concept that we're going to be trying to get at. Okay, fine. Okay, so really this is the basic idea. Is what we're gonna be doing. Okay, we're going to be talking about trying to get the value of a company and to understand the value of the company. Here's probably the thing that it's in bold. This is the key of what we're going to do. So we're after the present value of the future free cash flows. These are the FCFs, okay? Okay, that the company is going to produce or the project is going to produce. Obviously, these cash flows, because they're through time, they're going to need to be discounted, okay? So that you bring them to the present. Okay, so you're going to discount them by something that is called WACC in the main method. Okay, so this weighted average cost of capital. Okay, we're going to talk a little bit about this later. Okay, but we're going to talk about cash flows later, and we're going to talk about WACC later. Okay, but this is kind of the idea. I'm after the present value, the value of today, of the future free cash flows. Any idea what free cash flows are?
Cash flows after paying for capital expenditure. So it's usually operating cash flow minus capital expenditure.
Okay.
Whatever you have after paying operating expenses.
Not mechanically. What's the concept behind the free cash flows? Okay. I mean, it's not mechanical. It's not like the formula because it helps us. There's many ways in which you can get it, depending on the valuation method that you will use. Okay. So, but the idea is, it's cash flows that are free. Okay. So these are like, like French fries or freedom fries. Okay.
No, but I've always thought of it this way. It's the cash flow that the right-hand side of the balance sheet has after the firm has already invested in what it needs, right? It's the cash flow available for
Kind of, yes, it's even bigger than that, okay? So, I mean, the word free basically means that these are cash flows that are free from any other claim, okay? Free from any other claim. So these are the cash flows that you're really going to put it in your pocket, okay? So that's what they call free cash flows. They're not like, they're not like American cash flows, but they're sort of like, free from any potential claim, okay? And that's what you're going to be after in every valuation method, okay? Now you can add it through various methods, okay? But this is kind of the idea. Am I going to put it in my pocket, okay? For sure. That's kind of the idea, okay? Fine. What was I going to say here? Okay. Now WACC is going to be this concept, okay? This is going to be this discount rate, okay? Now. So it says it is the weighted average cost of capital, okay? So what does that mean? We're going to talk a little bit more about it, but what does WACC really mean?
Cost of equity by the amount the company gets of equity plus the cost of debt with the ponderation.
And if there's other securities like preferred equity, then you need to take that into account. So all the securities that are financing, okay, you need to take the weighted average cost of capital. Okay, so the WACC concept already involves the idea of the cost of the financing. Okay, so you're discounting the cash flows and imagining that you have no money and you're going to need to borrow everything to finance these assets. Okay, so discounting it by that value already means that, okay, if you're above, if you have a positive value, that means that this project is positive NPV, okay? Because if you were financing from scratch, okay, then you would have then you would have made some money, okay. So that's what we have. We want this positive NPV project, okay. Now there's something else embedded in the WACC, okay, which is not sort of like just the cost of the financing, but the cost of the financing. There's also there's a concept of the time value of money too. Okay, so we're gonna be also bringing in the time value of money. Okay, so the WACC has these two concepts of the discount rate. Okay, the appropriate discount rate of the cash flows is going to involve the time value of money, because bananas 7 years from now are not the same as bananas 1 year from now. Okay, and the cost of the capital, the cost of the capital that you're borrowing. Okay. Okay, so this is what people call economic value. Okay, the present value of the future free cash flows discounted by the cost of your capital through time. That's what it's called, economic value or market value of a company. Okay, now economic value, it's going to be, so in a sense, it's going to be very different from this idea of the balance sheet stuff. Okay, so economic value is very different from accounting on book value. Okay, have you guys taken accounting courses before in your previous life? Okay, so you should forget everything you learned. Okay, I mean it's a good basis, but we're gonna need to undo what the accountants do. The job of the accountants is to figure out, to have the accounts in order and to be able to tell you how much taxes you need to pay. That's the bottom line. Okay. But it's going to be very far away from economic value. Okay. So we're going to try to we're going to do a little exercise about how we do economic value and accounting value. Okay. So think about this accounting balance sheet. It's a very simple balance sheet. Okay. So here you have assets and liabilities. Okay, like the classic T account. Okay. So you have the assets need to balance the liabilities. Okay. Now, so we have some fixed assets like machines or land or something like that, so that's fixed assets. And then we have some current assets, okay? Now, current assets, the simplest one is cash, so you understand that very currently is the cash that you have, okay? You can also have some marketable securities, so market securities or financial investments, like if the company has invested in buying shares of, IBM or L'Oreal or something like that, it has some investments, okay? That are not related to the operations of the firm, but that's still a current asset, okay? And two very big categories, there's many more categories, but I'm just simplifying. Inventories, okay? So you have your inventories as part of your assets, so you have, you have them in the factory, and these are receivables. Does everybody know what receivables are?
The accounts what the
Account receivables, yeah?
with the other companies you supply the service to you.
Okay, so if you've sold something and people owe you money, that's a receivable, okay? So it's an asset because you're going to have it, so you register it, okay? So it's a receivable, account receivable, okay? So it adds up to 2,600. On the other hand, these are all your liabilities, okay? And it's basically who financed you, okay? Or to whom you owe money, okay? So we have, long-term liabilities and current liabilities, okay? Plus equity. So equity, these are your financiers, okay? So your shareholders gave you money, so that's the equity. Is that clear? Okay. Now, there's also debt, and there may be different kinds of debt, okay? So there's current liabilities, so it's going to be short-term debt, so that's clear. You're going to go to the bank with 3 months loans or 1 year loans, okay? There are payables. So what are payables?
The same as receivable.
I'm sorry?
The same as receivable, but in payable.
The opposite of receivable, okay? The same as receivable, but in payable, okay, fine. Okay. It's the other side, okay? So if you got the wood to make the tables, okay, and you need to pay it, okay? So you are gonna need to pay the wood to the guy. So the guy gave you 3 months to pay. Okay, so that's a payable. Okay, so it's a debt that you have. Okay, and then there is accrued expenses. What are accrued expenses? Yeah, so your accrued expenses, expenses that you already accrued, okay, and you haven't paid yet, really. So they're kind of related. So payables and accrued expenses are kind of related, okay? So in my mind, they're pretty much the same, okay? But the accountants will tell you, oh, this is a little different, okay? So it's pretty much the same, okay? This is like, wages or pensions or things like that, and short stuff that you may need to pay here, okay? Now, non-current liabilities or long-term liabilities, the simple one is going to be long-term debt. So you have a loan, a 5-year-old loan, a 10-year-old loan, that's long-term debt. If you owe pensions to your workers, well, that's going to happen. They're going to be here, and so on, okay? So but for now, we put it this way. So this is the accounting balance sheet. Is that clear? Fine. Now, so if you want, here are some definitions for you, okay? We're really fine. Now, the key thing here, okay, one key concept that we didn't talk about, okay, is this concept of equity, okay? So I had equity in the balance sheet, okay? So you will see, well, that's the value of the equity, okay? So that's how much the business is worth. So if somebody comes and buys it, okay, that's how much it's worth. But no, that's the book value of the equity, okay? It's an accounting value that it's anchored in the past. It's the book value of the equity. It's not, and what we're after is how much is the future cash flows worth, okay? And that's going to be different than the book value of the equity, okay? Because that's how much money people put in the business. That doesn't equate to how much money the business is going to generate, okay? Is that clear? Fine. So what else do I want to say? So this is the book value of the equity. So how do we compute the book value of the equity? When it has the original equity that was invested by all the shareholders, plus additional equity that comes in other rounds of financing. So imagine that you're starting your business with your money and your mom's money, and then you got a venture capital. Well, the venture capital guy is going to come here, and now you're going to add that, okay? And then if you issue shares, well, the value of the shares, the new shareholders are coming. So this is the additional equity that was invested, okay? And the profits that you reinvest. So if you go back to my slide number 5 or 6 in the first handout, we said that the company, although the company does is raises finance, invest, and then pays back, okay? In the payback function, either you give it to the investors or you reinvest it in the firm. If the profits you reinvest in the firm, then you add them there, okay? Is that clear? Okay. So it's important to understand that the book value of equity, okay, is not, okay, the value of the firm, okay? It's just how much money people have put in there, okay? Great, okay. So book value of debt is a little simpler, right? Because typically, debt is going to be very close to its true value. Okay, so the book value, our big assumption is the book value of debt. We think it's the true value of debt, but it may not be the case. Okay, okay, fine. Now, to relate the accounting balance sheet that I gave you to economic value, we need to reconfigure this accounting balance sheet. Okay, so we're gonna go back to this balance sheet. Okay, and we're gonna need to undo it. Okay, we're gonna need to do something to it. Okay, to really get to the economic value. What we're after is the value of the equity. Okay, that's anchored in the cash flows, and this is not really giving it to me. Okay. So we're gonna need to move forward. So we're gonna need to reconfigure this balance sheet. Okay, fine. So let's do that. Okay. So here are your instructions. Okay, you're gonna get me the economic value. Okay. So we're gonna first start to understand what's different between economic value and book value. In order to do that, you're gonna get your balance sheet. Okay, and you're gonna do the first operation you're gonna do. You're gonna split the cash that was in the split in this, you're going to decompose it into operating cash and excess cash. Okay? Operating cash is the cash that you need to run the operations. Okay? And you need it as a working capital. So it's the cash that you need to do to sort of like be doing business. Okay? And this cash, okay, it's going to be stuck in the business. So you're never gonna be able to put it in your pocket because it's sucked up by the business, okay? But then there's excess cash, okay? This excess cash you can put in your pocket, okay? So the operating cash is related to, how much you need by the company's needs, but the excess cash, you can have it, it's not required for working capital purposes, you could always take it out of the company and distribute it, and that's not a problem, okay? So we're gonna split it in two, okay? Okay, so this cash is typically why do people keep this cash and say you don't need it? Well, maybe an opportunity comes around, you want to buy something, you want to acquire another firm, just in case of strategic purposes, or for a rainy day, okay? Trump arrives, okay, so you pull out the cash, okay? Okay, so in our example, we're going to assume that $25 are required for operating purposes and $175 is excess cash. Okay? Fine. So that's instruction number one. Instruction number two. Marketable securities and financial investments, you're gonna take them out of current assets. Okay? Because you don't need them. Okay? These are shares of L'Oreal. They're not needed for production, for producing tables. Okay? You're gonna take them out of current assets and you're gonna relabel these current assets as current operating assets. So that's why you take them out, because they're not operating assets, okay? Is that clear? Instruction number two. Instruction number three, if there are any interest-bearing current liabilities, okay, you're gonna leave them on the sources side of the balance sheet, okay? So we're gonna create a new balance sheet, okay, which is gonna be called sources and uses. Did I put it here or not? Did I skip it? No. If you're going to create a balance sheet, is the next slide. I think. It's going to a balance sheet that we call uses and sources. Before we had assets and liabilities. Okay? And now this new balance sheet is going to be called uses and sources. Fine. So if there are any current liability, interest-bearing current liabilities, you leave them on the sources side of the balance sheet. And the remaining items, okay, are going to be relabeled current operating liabilities. Okay? So with all of that, okay, we're going to put this thing, we're going to change this assets and liability to something that is called uses of the money that you got and the sources of the money that you got. Okay? So uses equals sources here. Notice that this new value is going to be 2,200 and 2,200. So I'm giving you a clue. Okay? It used to be 2,600 on each side. Okay? So now it's 2,200. Okay? Magic. Okay? Because it's a little bit different from what we have. So what the accountants have put there is not really meaningful for us. Okay? They're just counting. Okay? Now we need to think about economic value, okay? Is it clear? Should I give you 2 minutes?
Sure.
Okay, you can work together, okay? In your groups or not in your groups, with your neighbors or without your neighbors.
Go back to the
To the other slide. So here's the other slide, okay? The trick. Let me give you, let me give you a hint on the trick, or one of the tricks, okay? We are going to be creating something, so you're going to create this spreadsheet with uses and sources, and you also need to be creating something that is called working capital.
Working capital.
Working capital. Okay?
Yeah.
So you're going to be creating something that is called working capital. And the idea of working capital, so what's working capital? Is the capital that we need for the company to work. Okay? So that's the working capital. Is that clear? So it's a capital that is trapped in the business. And this is going to be a very important concept because this capital that is trapped in the business, am I going to be able to put it in my pocket? No. Okay? So this is capital that is always going to be there. So I will never be able to put it in my pocket. And if I cannot put it in my pocket, do I want to pay for it? No.
No.
Because I only pay for what I'm going to put in this pocket.
Yeah.
Okay? Okay. So let's go. Yes. You done? Oh, what do you mean no? What are uses? Okay. So sources. So let me say it again. Sources are your sources of financing. Okay. Whoever gave you money, okay, wherever you got the money from, that's sources. And uses is what you use that money for. What did you do with that money? Okay, you put it in X, in Y, you bought something, you bought a machine, okay, it's in the bank, okay, all of that, okay? So that's uses and sources. Sources of financing and uses of financing, okay?
The fixed assets minus the current assets.
When I go after, not necessarily, no. Remember, you need to now create, just think about what is a use and what is a source and follow my rules, okay? I told you how to do it. Follow my rules. I gave you 4 tasks, okay? What I told you about what's operating and excess. I told you operating is 25 and excess is 175. I already told you. Yeah. So you need to split the cash in operating cash and excess cash.
Great.
And 25 is operating and 175 is excess. So I'm going to be creating, okay, so I'm going to have, so this is what I'm after. I'm after the uses and the sources. And here, there's going to be something here. There's going to be something here that is called working capital. So there's going to be certain items here that belong to working capital, and certain items here that are not working capital. And here you're going to have all your sources. Okay? And it adds up 2,200, 2,200. If I were you, I would start here.
Yeah.
Remember what working capital is, okay? It's the capital that is right here. So the working capital is all going to be here, okay? Are we done?
Not yet.
Oh, come on, guys. It's like a high school exercise, okay? Start with sources. That's a very good way to start. Read the instructions that I gave you, okay?
Que te provoca pagar intereses. No, no, no.
Read this instruction, guys. Here are the instructions, okay?
They are sources.
The instructions are very helpful.
O sea, son sources. they are left on the sources side. O sea, lo que claro, lo otro son all.
I mean, it is clearly the case that things are going to move from one side to the other, right? Some things are going to move, some things are not going to move, okay? And the things that are going to move are going to be part of this working capital.
Coño, claro, tienes que mover los payasos y los abrir defensa y al otro lado. Y se cancelan con la partida de eso.
Pero tienes que quitar.
Claro, esos working capital que se quita sin eso.
O sea, lo que es con interés se queda.
Lo que es con interés se queda y lo demás se va al otro lado.
Y lo que vas a hacer.
Y claro, ¿qué pasa? Que se va al otro lado restando.
Claro, claro.
Are we done?
Ya.
Ya.
No, the handout, where's the handout? Did you send it by email?
Vale, lo tienes silenciado. El de anuncio.
Ah, el de anuncio.
How are we doing?
Eh,
I cannot read anything, but I'm assuming that it's good.
yeah, okay. Okay, I'm gonna tell you later.
You're close, you're getting there. I mean, I think that you got this one.
Yeah,
okay?
yeah, of course. Yeah.
So you got that one, okay?
Yo creo que ya lo tengo. O sea, lo estoy terminando de poner eso, pero creo que solamente esto aquí. Y lo que falta se viene aquí como working rectangle.
And now detail all the items that are in this working capital, you should detail them.
Yeah,
So
exactly.
everybody is inside working capital.
It's trapped.
That when you see any interest-bearing car liabilities, you mean that, for example, debt is interest.
Yes.
From debt, you mean that they are paid.
Leave it there. Leave it on that side.
And the, so regular expenses are the current operating liabilities.
So what are you doing? You take them out of there. And where are you going to put them?
And it,
Here.
Put them in working capital. It's capital that is trapped. So here they almost have it here. I mean, he kind of has it. And how much does this give you when you net it out? You have it.
Yeah, 75.
Just check it, okay? So he has it, yes. Working capital is the capital that you need to run the business. So you're never going to be able to put it in your pocket. It's always trapped there. You need it. Okay?
for example,
For example, yes, that's right. So that's why you have account expenses on that side. Okay? Inventory, all that stuff. You know, you're never going to be able to.
O sea, lo que pasa es
That's
que
what we're going to get the concept of working capital.
los dos.
Okay, are we done? He has it. You have it?
Yeah, it's here.
Se suman 400.
Yes. So you need to spell out what's inside. Can
Yeah,
you go
yeah,
to that?
the more details. Like, yeah, okay.
Okay, are we done?
No, a ver.
So the left side of the table, you know, got it. Okay, the class got it. You know, in the center was Stormy.
No. O sea, lo tienes que llamar curro no pertinaz.
Okay.
Ay, mierda, espérate. Si hay curro no pertinaz, no, pero eso no entra.
Pero te suman porque son.
No, but it's better.
Estoy refiriendo como long term
Financial working capital is current operating assets.
O sea, que sumarlo tendría que meterlo en. Sería 500 pesos y pico, ¿vale?
No, because it's not operating. It's an interest-bearing security.
Prefiero que te saquen los
Are we done?
Ya.
ya está.
Yes. ¿Ya está? Done. How are we doing here? Okay. Yeah, I think it's one of the kind of is, okay? Okay, so let's try to work it out, okay? Okay, so this is what it is. So this is more or less what it is, okay? So what did I do? Let's start with this size. These are my sources. This is all the financing that I got, okay? So I got equity, then I got short-term loans and long-term loans. This is my interest-bearing liabilities, okay? Now, that's all I left here. Those are my sources. The rest of my liabilities are trapped in the business. They're part of my working capital. So my payables I have on this side, I move them here, and when I move them, they change sign, right? Okay, because they're gonna net out, these are my current operating liabilities, they net out with my current operating assets, okay? My accrued expenses also move from here to here, so I have minus 400 here, okay? And then the other part that is current operating assets is my operating cash, okay? I put it here because that's trapped in the business. The inventory is part of the business, and the receivables are, part of the business. Okay, so that's my working capital, which is 375, right, or something like that. Okay, minus this goes on, and it's 375.
Yeah.
Okay. Now my excess cash I split. Okay, this excess cash I don't need it. It's not part of my working capital. It's just there, And just so it's like the shares of IBM. That's not part of it. They're an asset of the firm. I use this money to buy this asset, okay? But I don't need it for the operation of the business, okay? Is that clear? And my fixed assets are there, okay? And now I have created something important. I have created now this concept about what are the sources of the company and what I use the money for. That's what I use the money for, okay? I use it to do all of this stuff. Okay? And now I have created this concept of working capital too, which is the money that I'm not going to be able to put in my pocket. Okay? So that's trapped in the business. Okay, is that clear? Okay. So, you can go through it. This explains what you did. Okay, more or less. Now, so this is the concept of the working capital. So the working capital is going to be this amount of money, okay? And so what are the uses why did I use my money for? I use it to buy fixed assets, okay? I use it to invest in working capital, okay? And I use it, and I have some excess cash, okay? So notice that the working capital is different between the current operating assets and the current operating liabilities, okay? So that's more or less what we have. Okay. Now, so with this reconfigured balance sheet, okay, now we know that that's different. So the book value that I had is different than the economic value, okay? So the main difference here is going to be, okay, the main difference is that the values in the accounting balance sheet represent what has been invested, and the values in the economic balance sheet represent the current value of what has been invested, okay? So the goal of these evaluation exercises is to try to figure out, okay, or try to ensure that the economic value exceeds the accounted value, okay? So basically, we want to make sure that the economic value of what you invested in is bigger than, okay, than the accounted value, okay? So what we have here, so this is the modified spreadsheet. So, and we're saying like with my business, okay, so I generate all of this amount of money, okay? So let's go back to what I have here in my spreadsheet, okay? So here I have 2,200, okay? So these uses of money, where I use them to have some fixed assets, I have some excess cash and some marketable securities, which are not part of my business, right? I don't need them. And this is the money that I need to run. With these assets, I would generate some value. So these assets are gonna generate cash flows, correct? Okay? The question is how much cash flows are they gonna get? Okay? So now I'm gonna move into what the true economic value spreadsheet, if you will, is gonna take this shape, okay? So the spreadsheet is going to look like this, okay? I have here, the assets that I don't use in production, right? From my uses, my excess cash is not used in production. That means that I can always take it out and it's not going to hurt my business, okay? My shares of IBM, I can always take them out, it's not going to hurt my business. The rest of the uses is generating the cash flow, okay? So these are going to be the free cash flows, discounted here, how much it's generated. Okay, and the question, and I'm telling you here, it's going to be 2,500. Okay, and I haven't just told you how we got it. Okay, but it's going to be 2,500. Okay, so this is what we're going to be calculating, the free cash flows discounted. Okay, and then you're going to have, this is what people call the enterprise value. Okay, so the enterprise value plus all of these other detachable assets, and that's how much the company is worth. Okay, so this is the economic balance sheet. The economic balance sheet of a firm is the cash flows that it generates plus the other detachable assets that it has that it doesn't use in production. Okay, and with that you need to pay all your liabilities. Okay, so you're gonna need to pay the debt back, the long-term debt back, and you're gonna need to pay the shareholders. Okay, so these are the returns for the shareholders. Okay, is that clear? So the economic value of the firm's operations is what people call often, the enterprise value. Now, so these are things that you can detach and you put, and sort of, they're outside of the value. So if we sell them, nothing happens to the firm. I can still produce. Okay?
The enterprise value is the free cash flows discounted at the WACC.
Discounted at the WACC. Okay?
And
So that's what we're after. And then once you have this, then you know how much this is. Correct? So once you know the cash flows and the value of the other assets, you get the 2,825, and now you pay back the debt, and then the rest is the value of the equity, and this is how much you can sell the firm for. You can sell the firm for this amount. Okay? So you need this guy in order to get that guy. But notice that this is not the value of the firm. Okay, these are the free cash flows, okay? Then the detachables, and then you need to take out all of the payables. And that's the amount, all the things that you need to pay. And that's the amount of money that you're going to be able to put in your pocket. Okay? Is that clear? Okay. So, the total value of the company then is going to be the enterprise value plus the detachable assets that you have. That's the total value of the company. Okay? And then once you take out the debt, okay, then you get the equity value. Okay? Any questions? No. So in this example, I assume the economic value of the debt is the same as the accounting value of the debt. And with the thing that was different was the equity value and the book value. Okay? The market value of equity and debt. But this may not be the case. Probably it is the case with short-term debt, because short-term debt, there's a lot of, there's not a lot of time for it to change value, okay? The interest rate risk is not there. But the value of the long-term debt is more sensitive to changes in interest rates. So this is what people call interest rate risk, okay? So the interest rates may move, the Fed changes, okay? So yesterday, the market already discounted. The people knew that, the new guy of the Fed, the Trumpy guy of the Fed is coming. They know that he's going to lower interest rates because if he told he's going to lower interest rates, the market already discounted that, okay? So that changes the value of the interest rates, changes the value of debt, right? So imagine that you got a loan, okay? You got a loan, okay, a few years ago when interest rates were very low, okay? Remember there was a period where interest rates were incredibly low, like before COVID and all of that, okay? And so if you got a loan at that point, so the bank gave you a loan and you start paying 2% per year, okay? 2%. Now, inflation has come up, interest rates have gone up, okay? So now, if you were to the bank today, the bank will tell you the interest rate is 6%, okay? So that means that how much is your old loan worth, Okay, who made a good business, you or the bank? I'm sorry?
The bank, because it.
No,
So
I did a great business.
Oh, you fix the interest rate.
Well, I got a loan in 2018
With the fixed interest rate.
with a fixed interest
Ah,
rate
then you made
that it was
risk.
paid in two. Yeah, fixed, yes. If it's variable, then it varies, okay, so then nobody makes business, okay? But if you, this is when you get your mortgage, okay, if you get your mortgage and it's very, very low, okay, then if interest rates go up, then you win, right? So this loan today will cost you a lot more, but you got it very cheap. So if interest rates had increased since you issued the debt, then the value would have decreased, okay, from the face value. Okay, so the face value is how much you said you were going to pay with the face, but in reality, compared to a new loan, the value of this loan, okay, the value of this loan has decreased. So this is what explains why Silicon Valley Bank went bankrupt, remember? And Credit Suisse, because they made tons of loans at practically very, very small interest rates. The interest rates went up, and the guys, basically were out of business. Okay? Fine. So in long-term debt, this may apply. Okay? So people, you may want to check for the value of debt. You may want to change that. Okay? But that's a little thing. Okay. So what is other little details that we will have? Okay. So in general, liabilities also include, in addition to that, other obligations like legal and environmental liabilities, liabilities to employees, etc., etc. Okay. And as I was saying before, the value of the equity is the difference between the total value of the company and all of its liabilities. Okay, so the total value of the company that we did in the last spreadsheet minus the liabilities and gives you the value. And this is what people call also the market capitalization. If you were trading in the stock market, that would be the price, that would be the value. Okay, all the shares times the value is the price times the number of shares will give you that. Okay, it should be equivalent to that. So this is what people call the current value of the equity, okay? And this is the value that shareholders will receive if they sell the company. Because the other guys are gonna pay, for the cash flows that are free from any other lien, okay? So that cash flows, I'm not gonna pay you for cash flow that are needed for the business to run, okay? I'm not gonna pay you for that because those are needed to run, that's gonna generate the other cash flow. And I'm not going to pay you for the debt because I'm going to need to pay the debt. Okay? So all of these are cash flows that are compromised. Okay? So you're going to get them out. Okay? Any questions about that? Okay. I don't want to say anything else. Okay. That's just the last position. If the company is publicly traded, then it's fairly easy to construct the value because that 1,675, a very easy way to get it is to say, oh, here's the price of the stock times the number of the shares. That's my 1,675. Now I know the free cash flows, okay, that I needed. So I could solve it that other way. Is that clear? If I'm a publicly traded company, okay, then I go to the stock market, I look at the price of the shares, I multiply it by the number of shares, and I get this number. And once I have this number, I have this, okay? And now I know this.
Okay, so it's a...
Yes, I do it the other way around.
Florencio,
Yeah.
for an overvalued company, that amount is going to equal the price times.
Well, if it's overvalued, okay, so the market may be overvaluing it, okay? Maybe.
But those numbers are going to match anyway.
Okay, so maybe what you do, when you do your exercise, you figure out that the market is paying you more, and then you say, oh, this company is overvalued. That's what it means, it's overvalued, okay? The guys are too excited, okay? NVIDIA, okay? So they're paying tons. I don't know if those are the free cash flows, okay? Okay, and when it's undervalued, that means that the market is very depressed about this, okay? And then you say, but my cash flows are good, okay? So we're gonna try, so there's many ways to get the value, okay? So, and then you need to determine if you think it's undervalued or overvalued or not, okay? But if you go to the market, you're gonna get this guy. And this is what you get from calculating the cash flows, okay? Any Is that clear? Okay, good. Okay, what else do I want to say? Okay, so the other thing that's important, the value of items, sort of like excess cash, marketable securities and all of that, it's 1 for 1. Because you can take the cash out, you can sell the company with the cash or without the cash, and people are going to pay you dollar for dollar. Okay? If you take it out, that's fine. You can sell me the company. It's not generating anything, so I'll pay you 175 for 175. Okay? You can leave it, or you can take it out. I don't care. Okay? The same thing with the shares of IBM. Okay? I'm going to pay them to you at the market price of IBM, or you can sell them. I don't need them. Okay? I can always buy shares of IBM myself, okay, at that price. Is that clear? Okay. So once you have all of that stuff, then you do this example, and you can then calculate the enterprise value as a residual. Okay. So if you go to the market, you take out all of these assets, and then you get the 2,500. Okay. Does that make sense? Okay. So here's, how do we get this 2,500? That's the big idea. Okay. That's the question. How do we get this 2,500? Okay? So these are all the ways in which we can get the 2,500. Okay? So there are several approaches that we're going to do, so that people use, and they all give you different values, and you're going to need to, calculate them and see where you are. Okay? Remember, there is not a true value. Okay? But you're going to get a range of values. It's not physics. It's not an exact science. Okay? It's an approximation of what the value could be. So with something that's called the net asset approach, okay? So that's going to be very much anchored in accounting, okay? This is the multiples or the relatives approach, so that's going to be trying to use similar companies to get the value, okay? Agree by multiples, and then there's the dividends, okay? So we're going to discount the dividends, okay? So the idea here is that what's the idea behind this method? Okay, what do you think is the idea? So why do I look at the dividends? I discount the dividends.
That's the money the investors get.
That's the money that you get. So a shortcut to that, if I look at the dividends, this is what you're gonna get. So that's the value of the equity. Okay, so this is a discounted approach to dividends, and then there's a cash flow approach to valuation.
The Gordon model is the one with the dividends.
This is the Gordon model. The Gordon model is the one with the dividends, okay? Which is just like a perpetuity, okay? It's a very simple perpetuity formulation, okay? And then this is the cash flow approach, and there's various methods in the cash flow approach. The most used is this discounted cash flows, DCF, okay? So the DCF, okay, is the one that people also call the free cash flow approach, okay? But then there's other methods, which is called capital cash flows, and then equity cash flows. And these methods are going to be used when the capital structure changes a lot. If through the life of the firm, the capital structure changes, better use one of these two, okay? Then there's another one that is called valuation in parts, okay? And it's just, you should just separate the parts, because not all the cash flows have the same uncertainty. So why would you discount all cash flows with the same uncertainty, okay? So you separate the part between uncertain cash flows and the certain cash flows, and you apply different rates. That's all there. Okay? So we're done with valuation. Okay?
Can we take a break, Prof?
Yes, we're going to take a break.
Yeah.
You can take a break, okay? So back at what, 10? 10. Okay.
110? No.
What time is it?
It's like 49, 9:49. Yep.
Okay.
10 minutes?
I will start at 10:12. Okay?
10:12? Half an hour?
That's 30 minutes.
Okay, that's great.
13 minutes.
跟买那个吗？哇，一起吃吗？还是不好吃啊？好像放。好，等一会儿。
Abstract from the other ones, okay? And I'm just going to focus on the one thinking about, I'm going to concentrate on trying to value Northwestern, okay? With the changes that he's going to come and take, okay? So the value that he's going to be creating, okay? So there's several kinds of valuations that one can do, okay? One of them is called status quo valuation, and this is status quo valuation is going to be, I'm gonna go and value the company, leaving it alone, not touching it myself, okay? Imagine that it's perfectly well run. It's just, I bought it because it's a good investment, but I don't know how to run it. So it's like the hotel next door. I buy it, but I don't know how to run it. Someone keeps running it, okay? So, but this, in this case, no, because he comes and he says, I'm gonna improve it, okay? So this is valuation, this is what it's called, and this valuation is called a control premium valuation. That is, it's not a status quo, I'm gonna change control, and that's gonna generate a premium, okay? So there's a status quo valuation, we'll see it later next time, also let me start there. So that you see which one we're doing, okay? So in reality, there's three kinds of valuations that we can have, okay? And it's gonna be very important to break them up. So it's what is called status quo. So it's as is, okay? So that's one. The second one is called control premium. Okay? And the third one is called synergies valuation. Okay? Is that here? So right now, okay, I'm gonna do this one. Okay? The one where Guzman comes. Okay? Or Guzman. Okay? Guzman comes and takes over the firm and makes some changes. Okay? So that's question 3 of the questions that I gave you. Okay? So fine. So in questions 1 and 2, basically we want to analyze a little bit the company, be familiarized with you know, why they're doing these things, how healthy do they look financially, is the business going up or down, and so on and so forth. Okay. So the problem of the case is that, you know, he wants to buy this, okay, and you know, they're asking for 95, okay, they're asking for 95 million in cash or in stock. And the directors of Nelson Paper Products are also asking for a plan to finance it. I'm not going to touch this plan to finance it, okay? Nelson Paper Products doesn't have a lot of money, so it's going to need to go and borrow some money to buy it, all right? So that's it's going to be a different kind of thing that we will need to add. For now, we're just valuing the asset, okay? In fact, Nelson Paper Products wanted to get more things going, so they need a lot of money, okay? So what it does mean is that if the acquired Northwestern Pacific is, you know, expanding, you know, the first outside, you know, venture that they have, okay? So fine. So, you know, now we need to kind of like look at how the company is doing, okay, in comparison and itself and in comparison to the industry, okay? So how is, let's start with Nelson Paper Products. How is it doing? Is it going well, badly, not badly?
It's growing well. I mean, it's during the crisis where like prices like plunged and like its competitors, it had like a decrease in their sales growth, but they managed to keep the sustained growth in their sales revenue.
So it's doing good, okay, with comparison with respect to the industry. With respect to the industry, so you have a few, okay, you have a few exhibits here, okay. So this is one that we could use, for example, Nelson Paper Products, okay? So we could use this one, okay? And this is basically saying, you know, sales, you know, seems to be growing, okay? Quite a bit, actually, okay? So it seems to be doing great. What else do I learn from this slide?
Is increasing all the time.
I'm sorry?
It's,
What did you say?
It's continue increasing after it bought like the wood company.
Okay.
Mm-hmm.
So it has, you know, so we see sales are doing pretty good. How is operating income? How efficient is the company?
It's growing.
Yeah, this, you know, efficient in the sense, you know, in terms of costs, okay?
Yeah.
Costs versus, you know, you know, we can look at this stuff, okay? So this says, you know, the cost, you know, so kind of like fairly constant, okay? So, so we can see that, it's not becoming inefficient. Seems to have some earnings per share, so this is the earnings per share that it's doing, so it seems to be doing fairly well, okay? So it actually almost doubled, okay? And it's paying some dividends, okay? And these are the stock prices that we have, okay, of this company. So the company is publicly traded, right? Okay. So seems to be doing fine in terms of this, okay? Then you have the other thing that you can do is you can compare it to with other companies, but of course, my slide is cut here, so God knows what's in each one of them, okay? So I think that from what I remember, we're gonna try to guess, okay? So here's Nelson, okay, so these were the sales, obviously, okay? Here we have some of the customers, where's the debt and the equity somewhere there, right? I think that what I want from this slide is, does anybody have the exhibit? Okay, thank you. So what we have here is the revenues are here, the net income is here, okay? These are the earnings per share that we saw, and this is the dividends per share that we saw. These are the stock prices, okay? And here is here's finally what I need. This is the total capital. This is a book value. So you can see here, this is total capital. This is the debt, okay? The percentage of debt and the percentage of equity, okay? So it's 26% debt, 71% equity. So it's not highly indebted. This number is something that is called the interest coverage. Do you guys know what the interest coverage is?
No.
It's an option, no.
I'm sorry?
It's not. It was not an option. The interest coverage.
An option.
Uh-huh.
No, for a company, it's a ratio that you calculate and you say, like, how many times does my net income can cover the interest that I'm paying? Okay? So it's how liquid, how solvable you are. Okay? So you can see that it's 10 times. So it's fairly good. Okay? So that's the interest coverage. You can see that it's, compared to the other ones, it's doing fairly well. The interest coverage of the other ones is doing fairly well. And what else do I have? Oh, this company has a bond rating, so it has a bond. Okay? So it's BAA, so it's kind of like, okay, it's not great, it's not AAA. Okay? And this is something that I'm going to need, which is the beta. Does anybody know what the beta is? It's a beta of 1, a beta of 135, a beta of 195, and a beta of 0.8. What is the beta? You guys know?
The firm risk.
I'm sorry?
Firm risk.
So it's getting into the firm risk. So the beta is the co-movement with the stock market. Okay? So the beta is the co-movement with the stock market. So this is when the stock market moves this way, how much do I move? So a beta of 1 is I move exactly with the market. Okay? That's a beta of 1. Okay? So it's an industry that it moves, it's very cyclical. It's an everyday industry, wood. It's an everyday industry, like electricity or something like that, okay? So it has several components. It has 2 components that we're going to see later. It has a component that is the industry, okay? But it also has another component that is coming from the capital structure, okay? So it measures the risk in that sense. So it measures the industry risk, okay? And it also measures the financial risk. So companies that are more highly indebted would probably have, for example, this one, okay? So this is, you can see here, it has more debt than this one. So in general, this company probably has a higher beta, okay? Because it has, the industry plus the financial risk, okay? Right? So how do you get these betas, okay? How does anybody get these betas if you were going to get them from scratch, okay?
A regression, your returns versus the S&P 500 returns.
The
So
Kaplan model.
what you look at, I'm sorry?
From the Kaplan model.
From the Kaplan model, so you will get the beta, the simplest way to get it, the simplest way to get it, it's kind of like mechanical. You don't even, what you do is you're going to imagine that you have the S&P returns here on day 1, T1, T2, T3, T4, okay? So you have the value here, so you have the values here, and here you have your stock, this is called Nelson products, and you have the value of the stock here. So you're gonna see when this one changes this much, how much does this one change, okay? So you create the changes. Okay, so you create a column of changes. Okay. Then you just run it. You run the regression. So it's the slope. Okay, you run a regression and this is the slope. Okay, is that clear? So if you have the prices of the stock at the stock exchange, so you can see how stocks move. Okay, is that clear?
Yeah.
Now, so a beta of 1. So let's do betas. Okay, so a beta of 1. A beta of 1. So if we have this. Okay. A beta, so this is the stock market, okay? So it's moving like the stock market. So it moves exactly like this, okay? It's moving like that, okay? A beta of more than 1, moving more like the market. So it's looking like this, okay? So this is above 1. A beta of less than 1,
Flatter.
it's a little bit flat, it's flatter. A beta of 0, it doesn't move.
Yeah,
Okay.
this is a
Doesn't
is a
move with the
line.
market, it's 0, it's here, okay? And so on, okay? So those are the betas, how much you move with the market. So it's measured kind of market risk, okay? So it's the co-movement with the market. So that's gonna be a component of the valuation because that's gonna enter into my weighted average cost of capital, okay? So my cost of equity. So the beta is gonna be important to calculate my cost of equity, okay? Because if the company moves a lot, it's very risky, then equity holders are going to ask me for more returns.
Exactly.
Okay? And if it's very safe, they're going to ask me for safer returns. Okay? Does that make sense?
Yeah.
So I'm going to need the beta. Okay? Fine. So I have that there. Okay? So we can see that, so this is another important thing. I'm going to get the beta. Okay? Now, so how does the company look like? The company is like you were saying. For 10 years, it has got fairly recent revenue, mostly growth through internal expansions, and now it's going to try to move ahead with its external expansions. Okay, fine. Now, is it facing any challenges? This is what we talked about. This is the idea that it probably needs to integrate, okay, because of the new regulation. Okay. And they had a project of these mini mills which required this amount of money, and they had some external finance. We're not going to deal with it now, but this is more or less what it's needed now. These are the challenges that it's facing. Okay, it's not going to be important for now. Okay, so what do I have here? This is Nelson Paper products again. This is the pro forma of the one. So it's what's expected here. Okay. And they're expecting some decent growth, okay, from what they have. So they're expecting some increase. This is what they expect. They expect to keep paying dividends. They think that, in addition, their income is going to grow also. Okay, the net income and the sales are going to keep growing. So this is their projections, okay. This is the assets and the liabilities, okay. So they're going to keep growing. Fine. Okay. So now this is them, okay? Now let's look at Northwestern Pacific, okay? And this is more or less what you guys said, okay? This is a company that it's been having, this is a company that has been having a few problems, okay? This is its business. It had rapid growth with internal expansions and acquisition of small lumber, but now it's going down, okay? It's not doing so great. So in fact, if you look at the statements, net income has gone down a lot. The cost of sales has increased a lot, and the dividend policy is very, very choppy, okay? So if we actually looked at this, if you looked at the past, okay? So see how sales don't seem to be growing as much as think about Nelson Paper products. The growth here is much smaller, and importantly here, the costs, have actually skyrocketed. Okay, and so it seems that these guys are not doing really that well. Okay, and the dividends, which you cannot really see here, it's very choppy. So it's paid 0, 25, 36, 0, and 0. Okay, so it's like a complete disaster. Okay, in terms of dividends. So right off the bat, when we're thinking about the dividend model, this company is not going to be a great candidate for the dividend model because it's just,
It doesn't
we're
pay.
gonna, how we're going to deal with this, okay? This is going to be a disaster, okay? Now, if you compare it with the industry, you actually are going to see that this is the firm that is hit much more than the other ones, okay? So its earnings went down much more than the other ones, okay? The dividends, were also changed a lot, and the revenues, the revenues are there, but the net income has gone down a lot because costs have increased a lot. So if you compare it here, now thank God I have the things here. So we can see here's our Nelson paper, Northwestern Pacific. So you can see how, the earnings, are very choppy, okay? The earnings per share and the dividends are incredibly choppy. So they pay here and then they don't do anything, okay? So you can see more or less that kind of problem. Why is this empty?
Because they are not publicly traded.
Because they're not publicly traded, okay? So I cannot get the prices, okay? And here's my proportion of debt to equity, okay? So it's about 20, okay? What is it? 15 and 85, okay? Now, their interest coverage, okay? Does it look good?
I mean, not too bad.
Not too bad,
No.
okay? The company doesn't have a public bond, okay? So it doesn't have a bond. And then I have, this is the number of shares outstanding, which I'm gonna be using, okay? So what's the beta of this firm?
We don't know.
We don't know because it's not publicly traded, okay? So I can't calculate that because I don't have this, the change in prices, okay? So so in order to get the beta, I'm gonna need to use the competitors of the industry. So notice that these guys have betas, okay?
Yeah.
Okay, so this is when we're gonna do this. This is when we do the twins. So we're gonna be using the twins. Okay.
Twins.
Any questions? Okay, fine. So that's more or less where we are. Okay. So typically that's something that for example, in your final exam or something like that, you get your case. Okay. I will guide you, but you need to understand the question. You need to understand the firms and see what the problems are. Okay. Okay. So what else do I want to say? So this is more or less, what you guys said before, okay? The minority shareholders of the firm want to cash out. They say, well, the guy that was running is retiring, and they just don't want to deal with it. They just want to cash out and move on, okay? So they want to sell the firm. It was for sale, and they had a bid for 65. And they said, no, that's a little too little, okay? So they're now asking for 95. Okay, I don't know. Is 65 too little? Is 95 too little? Too much? God knows. That's what we're going to value the firm. Okay, so that's what we need to know. So what does the future look like? Well, the future doesn't look like that great unless they do something. But they come up with this idea that they're going to be up and running in 1993. Okay, so if you look at it, they say, income is going to go up and we're going to start paying dividends again. So if you actually look at their pro forma, okay, the statements, is these guys the future seems to be very rosy, okay? So they're gonna growth is gonna be much higher than what they had before. The cost of sales, it seems like they're gonna kind of this is a 0.9, so they don't think that they're gonna do better, okay, in that. Okay, but they think that they're going to grow more. So here, it's just, when you look at the profits, the profits are going to grow. Okay, that's what they said, and they say that now they're going to start paying dividends. Okay, so this is the amount of dividends that they're going to be paying. Okay, this is their depreciation, the capital expenditures, their change in working capital, and this is the debt that they need to repay. All of these elements we're going to use in evaluation. Okay, that's what they're there. Okay, because we're going to need them to calculate the free cash flows. That's the cash flow that I'm going to put in my pocket. Okay, does that make sense? Okay, fine.
Florencio, when
Yes.
you build like a forecast, do you?
This is the forecast.
Yeah, you try to do at least like 3 scenarios, like the worst.
Yeah, so people will do worse and bad and so on and so forth. Okay, so take this as the middle one. Okay, People try to do 3 scenarios, the bad one, the good one, and the other one, and then evaluate the cash flows based on that one. Yes. And or people do some sensitivity analysis. Okay, that is, I'm going to be sensitive to growth rate or sensitive to WACC. Typically, the 2 ones. So I'm going to, if I change my growth to this, how much would that be? If I change my growth to that, and so on and so forth. Or if my discount rate goes up by this much, by that much, etc., etc. So sensitivity analysis or scenario analysis. Okay, that's what we're going to do. Okay, fine. So the decision is, should they buy it, and for how much should they buy it? Okay, so fine. So let's see how far I can get, because we finished what, noon? Okay.
No, 11. So we have 20 minutes.
Yeah, we have 20 minutes.
Okay, so I think we'll finish the handout in 20 minutes. Okay. So okay, so
110 slides left.
yes. It's gonna be, so it's 5 slides per minute. Okay. So the question is, he thinks, okay, so if I use this statement, so that's the question to indicate, if I use this statement, okay, if I use this guy, I will be doing a status quo evaluation. That is, I buy it, you run it. These are the projections from the current management. So you leave the current management in place, I would be using this cash flow. Okay? Is that clear? So that's the status quo evaluation. Now, Gosman thinks he's going to do better. Okay? So Gosman thinks he's going to do better. He thinks that, okay, he's going to improve. So these are the assumptions on the new management. So this is going to be a controlled premium valuation. Okay? He's going to change this statement into his. Okay? And what is the things that he thought he was going to do? Okay, he said the following things. Okay? What I'm going to do is many things. Okay? I'm going to try to put them in the statements. Okay? So the first thing he says is the cost structure is incredibly heavy. Okay? So I'm going to improve it. So he thinks that with a better manager, he can reduce costs to 85%. Okay? Right now they're 91. Now, Gosman also thinks that he's going to eliminate a lot of duplicity of the mini meals, and that's going to have a decrease in sales and general administrative expenses he's going to bring it down to 7.5 in the next 3 years. Okay? And he feels confident that he can do that because he knows the business. He actually was buying from them. It's proximity, so there may be some extra synergies. Okay, and other benefits from him is that it allows him to expand in these other wood products. This is the chips. Okay, and secure a captive supplier of wood. Okay, which is what we need. Now, I'm not going to value anything of this in my valuation. We're just going to take account of these 2 ones, okay? And we're going to use the capital structure of net operating profits. So when you buy, you typically come and buy, and you may change the capital structure of the guy that had it, because now he's going to be under you. So you may put him under your capital structure. So these are the 2 things that we're going to do, okay? Plus the capital structure. Is that clear? Okay. Why wasn't this? Okay. Okay. So here's the let's do let's do several approaches. So the first approach is what's called the net asset approach. Okay. So what is the net asset approach? It's a fairly simple one. Okay. Is you're gonna use your account statements, and you're gonna get the net assets. Okay. So it's a good starting point. Okay, to try to do that, it's a good starting negotiating point. Okay, so it's a first approximation. Okay, we can create it very simply. Okay, and there's maybe relevant for companies that are experiencing financial difficulty. Okay, and maybe you cannot sell them as a going concern that is going to be producing cash flows. So it's kind of like a little bit like a liquidation or something. You have to sell your assets and you pay your liabilities, that's what you get. Yeah.
And this approach, you don't deduct like the current liabilities from the net assets?
In this approach, what we're going to do is you just do net assets. okay? You're gonna be paying netting, all of that is gonna net out, okay? So in this approach, the typical way to do it, okay? You go to your Exhibit 7 and you say total assets minus total liabilities, and that's book value. That's what people call the book value, okay? And that's the 65 that people had before, right? That's the 65.
Oh, yeah.
So people say, hey, I'll give you 65, that's a book value, okay? And then they say, no, this has some generating power, okay? Fine, so that was the net asset approach. Now, this has a lot of problems, okay? Well, because it's accounting based, so it's really not looking into the future. It's not really looking into the generating power of the assets, okay? And all of these assets, okay, are shown in the books at original prices, so it's not even market prices, right? So this is at how much you bought the assets, but the prices may have changed a lot, going up or down, okay? So that's bad, and it's difficult to deal with R&D and patents and things of that nature, okay? But it's a good approximation, it's the first approximation. So now people have tried to improve this, okay? And this is 3 ways to tamper with it, okay? So the first one is what is called adjusted book value, okay? So we're gonna adjust the book value, okay, to try to bring it to market prices. The second one is called liquidation value, and the last one is called replacement value. So the adjusted book value is basically we're gonna try to get the assets into the market value, the current market value. Forget about the book value of the land. Okay, I'm gonna see how much does the land sell for now today, and I'm gonna put that. Okay, my machines, I bought them at 1,000, but maybe I've used them a lot, so maybe I can only sell them for 500. Okay, and so on and so forth. My inventories, okay, can I really sell them at the market price? Maybe I need to discount them, and so on and so forth. Okay, so that's more or less what people do here. Okay, okay, so that's adjusted book value. The second one is this liquidation value. So this is the idea, if I were to liquidate, how much would people pay me? Okay? So I want to tell you, here's the machine, how much you would pay me, here's the land, how much you would pay me, and so on and so forth. Okay? So it tends to be, liquidation means also that you're selling in a rush. Okay? So it may be less than adjusted book value because you're selling things in a rush. Okay? So if in the industry there's a downturn in the industry, this is how much you would get. These people, this would be like a very good floor. Okay, because in any negotiations, right? Because that's the worst that can happen to you if you just shut down and sell the pieces. Okay, is that clear? Yeah.
I have a question about the adjusted book value because we said we were going to revalue tangible assets, but isn't it like a special exception of IFRS? Like you can just revalue assets just like that.
You mean in accounting or what?
Yeah. Like, do these valuations need to be like IFRS or US GAAP compliant? Because I thought we only revalued.
Well, to begin with, okay, the accounts are already or need to already be whatever the regulation is going to be. Okay, so the accounts that you're using are already IFRS, whatever. Okay. Now, if it's a private company, you may not need to be doing that, okay? But the accountants, it seems to be what you do need to do is the statements need to be according to the accounting rules, okay? That you have. That's what you must start with. So what we're going to be using is what the accountants use. So they were already IFRS, whatever approved, okay? Normal, okay? Fine. Now. The last one is the replacement value. The replacement value basically means, imagine that Nelson Paper Products, if you don't buy me, how much would it cost you to create me? Okay? Okay, so it's like, you're gonna need to go and find some land and some wood, and you're gonna need to buy those trucks, and you're gonna need to put, so how much would it cost you at market prices to replace me? Okay? In the case of a house, for example, okay, so when you have your insurance company, you cares very much at your replacement value. That is, if you were to construct your house as is, how much would it cost?
That's like the roof for the buyer, no?
Yes. So this tends to be, this is probably, this probably is going to be a little higher. Okay? Fine. Any questions? So those are the net asset values. So we just calculated one. So what we started to do now, okay, is we started to. So we're going to start by creating a football field. Okay, this is the very famous football field. Okay, of valuations. Okay, so it goes from 100. Okay. To to 200. Okay, let's say let's go at this point to 300. So this is 150. Okay. So the first valuation method says the net asset value. So my NAV. Okay. My NAV is here. 65. Okay. Now I got my first valuation. Okay. And then I'm going to be putting all the valuations there and see how it happens. How it goes. Okay. Now let's do multiples, which is all I think I'm going to be able to do now, okay? And then the rest you do at home, okay? Okay, so here we go. Now, here's the multiples approach, okay? So the multiples approach, first of all, there's two kinds of multiples, okay? They're called multiples because we're going to be using, in the first bucket of multiples, we're going to be using our multiples that come from trading, okay, prices, okay, of similar shares, okay. So we're going to be using typically, we're going to be using prices of the shares, comparable prices, okay. So they're called trading multiples because we use the price of similar stocks. The second group of multiples are called transaction multiples, okay. Transaction multiples is like I'm not going to be looking at the prices of stocks in the wood industry. I'm going to be looking at other transactions that happened. That is somebody that came and bought as an equivalent of Northwestern Pacific. Okay? And I'm going to see the multiples that they paid in that situation. Okay? So when you're using multiples, the question is which multiple, okay? And what you put in the denominator. Okay? So typically they are valued as multiples of earnings or multiples of sales or of book value, okay? And so you can be using historical values or industry averages, okay? Whatever you want. So the valuation of a firm may also be done by capitalizing earnings, okay? Or so you're going to be using earnings involving a figure with some capitalization factor, okay? I never really like that because it's another mystery floating around, okay? Or, the simple one is price to earnings, okay? So this is the PE ratio, the very famous PE ratio, okay? So it's the price of the stock over the earnings per share, okay? So the question is which earnings am I going to use and which factor am I going to use, okay? So people use many things, okay? So you can use historical earnings, you can use future earnings on the present ownership, but then you will be doing some kind of status quo. Or you can use future earnings on the new ownership, okay? Predicted earnings, okay? Or the historical ones, okay? Now, most valuations use earnings after taxes, but before extraordinary items. Why?
Because it gives the cash.
Yes, because, so
It's more
it's
like
extraordinary
an
items,
It's more liquidity. If you don't take account the extraordinary.
Yeah, so here, extraordinary items are extraordinary, okay? So they're not going to happen all the time, so it's not normal earnings, okay? So that's the bottom line is you want to take them out because that's not really, it's not going to happen in the future. I'm interested about the future, okay? People also use what it's called earnings before interest and taxes, okay? Maybe because, taxes may change, okay? Or interest may also change with the capital structure, okay? So EBIT is a measure of the earning power of the value of the basic business. This is how much earnings it generates. Interests and taxes are not part of it, sort of like the generating power. Interest depends on the capital structure. You may want to change the capital structure and so on and so forth. So that's going to change in the denominator, okay? Because if the financial structure changes, then the interests are going to change, okay? Okay.
What is the example of an extraordinary?
So last year there was a lot of rain, okay, and the mountain collapsed on one of my factories and it destroyed, okay, 100 machines, okay. So that I took a loss, right? But you know, the mountain doesn't fall on top of me every year, okay? Hopefully. Okay. So as I was saying, there's trading multiples and there's transaction multiples, okay? The trading multiples, okay, are multiples that we use, okay, multiples that we use based on the trading prices of the shares, similar shares or your shares, okay? So we're going to try to be looking at the earnings, for example, of the industry and see what the market does. Okay, so let me try to do a couple of them. Okay, so let's do some of them so that you feel that, okay, maybe I can move it. Okay. Okay, so here trading multiples, the most common one is this PE ratio that I talked about. So what does the PE ratio mean? Okay, it means that a company that has a PE ratio of 10 means that investors are willing to pay $10, okay, for every dollar of earnings, okay? So today's PE ratios in New York are at the highest level they've been in the last 45 years, okay? So people are paying 25 per dollar of earnings. Must be the productivity is going to grow like crazy with artificial intelligence. God knows, that's the bet, okay? So a P ratio of 10 is already high, but a P ratio of 25, 30, 40, it's a little bit higher, okay? Just to say that, okay? Now, you can do PE, but you can also do you can use other earnings multiples, okay? So for example, you can do equity value over sales, or equity value over EBITDA, or equity value over EBIT, or firm value over net income, okay? So those are earnings multiples. Then there's book multiples, and when the book multiples is you're going to be using assets, the book value of assets, okay? The book value is a measure of the value of the firm based on historical cost of assets, okay? Now, this is historical, so, all of these multiples are historical, okay? They're a little bit forward-looking, but not as free cash flows, okay? Fine. So this, for example, price to book, it's going to be the market price per share over the book value per share, okay? Okay. So let's do that. So here's the Nelson Paper Products example. So I'm going to use, okay, what I'm going to use is the following. Okay, oops. I have 4 competitors. Remember, you showed me your thingy, remember? Exhibit, whatever it was. What is the 4 competitors? Okay. Nelson. I'm going to use Exhibit 9, okay, which has all my competitors. Okay, and I'm gonna see, what they're trading. So here's the 4. So what I have is, I have CS, which is here, so it's Chase and Smith, Longview Fiber, and whatever it is. Okay, the other ones, and I have one of them. Okay, so from this table, I'm gonna be able to get all these numbers. So I'm gonna get, for example, here I have revenues. Okay. So I go to the revenues here, so it tells me revenues in 92 is 185, okay? So that's 185, it's 691, okay, here, okay, and it's 2,185, okay? And I put my revenues, so my revenues, Northwestern Pacific, 1992, it's 2001, so I have it here, okay? Is that clear? So you feel that for revenues, for earnings per share, which are also given here, or you calculate on your own, okay? This is the price per share, okay? So I got it from here, remember we had mid prices and high prices, I get the mid price. So these shares are traded at 22, at 15.9, at 23, and at 13.5. Is that correct? No, that's a trade. The company doesn't trade, okay, remember? Okay, it's a wake-up call, okay? So this is fake, okay? It's a Trump number, okay? It's a fake Trump, okay? Fine. So now this is the price per share, okay? Now this is the number of shares, okay, and that I do have. So I get the number of shares from here, and I do have 6.3 million shares here, okay? Is that clear? And this is the book value, and the book value I get it also from here, okay? So I go and get my book value that's coming from my statements, is, 170, 829, 1 and 2, and 77, okay? And then I have it. Is that clear? So I got them all from here. Now, let's calculate the multiples, okay? So I'm gonna calculate different kinds of multiples, okay? So let's start with equity value over sales. So I'm gonna go, and how do I calculate the equity value over sales? Well, how do I calculate equity value?
We just saw it, right? We did free cash flows.
No. I'm gonna use some multiple. I'm not calculating cash flows. This is multiples. How do I calculate the equity value of this guy? Price per share times the number of shares. Wow. Okay.
Yeah, but
So here we go. So the price per share is 22 times 8. Price per share times the number of shares. Okay.
Yeah.
Divided by the sales. Okay. Revenues, and then I get 0.95.
yeah.
Okay. Is that clear?
Yeah.
I do the same for this one and for that one, okay? And now what I'm gonna do here is I'm gonna calculate the average of these three. So this is the average multiple price per sales, okay, per dollar of sales, okay? For all of the sales, you divide it by shares, then you get that, okay? So now I have 110, so what I'm gonna do, I'm gonna use this 110, and I'm gonna multiply it by my revenues, and this will be how much you should pay me. If we use the multiple in the industry of 110, the sales are sold at 1.1, okay, in the market for my competitors. So now you should pay me, according to my sales, you should pay me 220, okay? So 220, okay? So this was my equity value over sales from trading. Okay? Is that clear? Now I can do the same, okay? Market to book value. So how do I do market to book value? Again, is price times the number of shares divided by book. Okay? Divided by the book value. Okay, and then I get this multiple. When I multiply it by mine, okay, my book value is here, I get 86. Okay? PE is the same, okay? Now it's a little bit easy, so I have, this says 88, sorry, market to book, okay? It's 88, right? 88, so this is market to book, okay? Now, I can also calculate my PE, so it's going to be the price per share, and the price per share divided by the earnings per share. Okay? So I need to divide earnings by shares, by the number of shares, and then I calculate that, these guys are paying $17 per dollar of earnings, 25, 14, so it's 19. I multiply it by my earnings, okay? And then I get this number, I get 36, okay? So if I get my 1992 number, so this is PE of 1992, okay? Now, if I use the earnings, this is past earnings. If I use future earnings, predicted earnings from the statements, then I would actually get 84, okay? So you see there's a little bit of a variation, okay? So this is PE of 93. Okay? So now I'm starting to get a few values. Okay, is that clear? Any questions about it? Yes, no, maybe? Maybe. Am I going too slow? Too fast? Is it okay? Too perfect? Yeah. I'm sorry?
What was the reason for the assumption of 30.5?
This one?
Yeah.
This was just a trick, just to wake you up, okay?
Yeah, we actually use the averages to compute.
No, I didn't even use the average of this one, okay?
No, I
I
mean-
just
I
put
mean
a number there, okay? Just to trick you. So the reason is, I'm bad, okay? I just wanted to trick you, okay? So that's fine. So is this clear? Okay, so I think I need to let you go. So this is exactly the same thing with the earnings, okay? So the transaction multiples are, should I do transaction multiples? You want me to do transaction multiples? I'll do transaction multiples and let you go, okay? So we're trading multiples and there's this transaction multiples, okay? So the transaction multiples is I'm going to look at other transactions, other people buying Northwestern Pacifics, okay? And the benefit of this one is that when I'm using trading multiples, it's like when I'm buying, it's like if I want to buy a few shares, okay? But if I want to buy a full company, then why don't I look at full company buyouts, okay? And these transaction multiples tend to be higher because when you buy a company, you're buying control. So control has a price, as you probably saw in the 300-page handout, okay? Before. So control has a price, people pay for control, okay? So they're probably going to be a little bit higher, okay? Right. Okay, so they provide a good measure of that. So they tend to be higher because there's a control premium. Okay, fine. So now, in this case, there were a couple of transactions that happened. Okay, so you can see. So there was Patterson acquired Foley Wood, and Maidstone acquired Shinnecock. Okay, and this is that around the date. So you want to have transactions around your time. Okay, so this is the date at which they happen, and this is how much they pay. Okay, the offer price, so how much they gave the company, as a proportion of earnings per share. These guys paid 28 and 29 as a proportion of dollar of assets in book, 0.19, 0.27. So I get the average of the two, okay, and then I get I get my value per share. Okay, how do I get that? Let's start with this column. So I have here the earnings per share, okay, that I'm going to get, times the average number. So this is the average number here. And now I'm going to look at my earnings per share of the company. So if I multiply this, I'm going to get 9, okay? And if I look at this book value, okay, I'm going to get 15. So this is my book value times this ratio, 15. So that's how I got this 2 per share. So now I multiply it by the number of the shares, okay, here's what I have, and this is the equity value, 58 and 98, okay, 94. So I have all the ones, okay, I have a 58 here, okay, I have a 94 here, okay, that's what I have, okay, and you can calculate many more, okay, so here's a couple more, if you can want to go practice, you can go practice, okay. So if I use all of these multiples, all of the multiplicity of multiples that I could calculate, I'm going to get a range that ranges between 58 and 97. So that's already giving me some kind of range. Okay? Any question? So that's multiples. Now, what is the benefit of multiples? Okay, and the limitations of multiples. I mean, the benefit is that they're quick. You can do them. It's easy, any monkey can do them. Okay. With some little training, okay? And but the problem is that multiples, okay, it provides you a measure of the value that is consistent with comparable companies in the industry. So you need to have comparable companies. So the more comparable, the better the multiple is going to be. The less comparable, the less it's going to be, okay? That's one problem. The second problem is that it's kind of like a static measure. It's focused on, like, you saw when I changed the earnings from year to year, it tripled the valuation, okay? Because if you had a bad year, okay, so maybe you want to have multiples of several years of earnings or things of that nature, okay? So, but it's kind of like a static measure, and it's not really measuring earnings in the future, okay? So that's problem 2. Problem 3, okay, the assumptions embedded in the multiples need to be very carefully considered, because not only you want comparable companies like in the same industry, the same side or something, but also similar capital structures and similar expected growth rates, okay? Because the prices are already thinking about that. So those are limitations. There's not much more that you can do there, okay? Yeah, I'm gonna skip that. Okay, so that's what I'm gonna do. So when we come back, we're gonna do these other models on Monday, okay?
Monday,
So we're
okay.
gonna do the case Monday, right?
Yeah, we're gonna do the case one.
And we're gonna do the case, and we're gonna do this other, whatever I can do on that, okay? Questions?
On Monday, how is gonna be the presentation?
Fun, a lot of fun. So how many teams do we have? 6 teams, right?
Yeah, and one of the teams is of 2.
One of the teams is of 2.
Yeah,
Why?
Because
guy.
one guy is quit. Because me and her, we two as a group.
You're lonelier. Okay, so I think everybody will get to present, okay?
Everybody.
I think everybody will get to present, okay? So just make sure that we ensure a presentation, just in case we can actually do the main, the simulation, okay?
Okay.
So we get to present. You do not know what you will present. You do not know what you will present. We're not gonna have 6 presentations of everybody, okay?
Okay.
Because that would just kill me. And you, okay? So I'm gonna allocate questions.
Okay. It's a
Okay?
random.
So we will typically see 2 or 3 versions of the question,
Okay.
depending on how bad the first or the second one are, okay? But you should be ready to present everything, okay?
Okay.
Remember, this is kind of like a finance course, so it has to have numbers, okay?
Mm-hmm.
Kind of a finance course, okay? Okay, so I'll see you on Monday. What time do we meet? 8:30 again?
Yes,
8:30.
Thank you.
Yeah.
This is my this is
Bye.
Sí, porque toca hacer.
Lo único que me quedo de que no aprovecho el día. Que no está mal que no aprovecha el día.
Pero
O sea, mucha gente que da ansiedad no aprovecha el día.
Bien, Dani.
a mí no me da ansiedad ninguna.
Pero ayer empecé un anime, ¿no?
Sí.
Ah, vale, no, que ahí te das cuenta.
¿Ayer te viste un anime? ¿Cuál?
Se llama La Ley de Hueco.
You should actually try to work on the evaluation yourself a little bit, Nelson.
Okay.
Just look out there and see what's going on, so that it's easier.
Yo pensé que teníamos que traer las preguntas hechas y estaba en la página principal, todas.
Espérate que capo morfeo.
It helps.
Es que
¿Sabes qué? Me interesaba un montón hacer la parte en la que Nelson tiene que recibir las 3 opciones de financiación. Estaba como en Tinder, estaba como en equity y como corporate bonds.
I don't know if I'm going to switch now.
I should go to like.
But I usually at some point in the
I had to do something stuff.
I'm very sleepy.
I had to do something navy.
Yeah, I know. Prep days, like you almost have like
This week has been tough. So many questions.
wow.
That's the worst thing we can do.
Sounds good.
I mean, this semester better, but I mean, the subject is dense and it's like it fucks your mind.
Is it better to do those 2 things are different.
about ownership, cash flow rights, controlling ownership.
Y luego a extraer las páginas que diga al Excel. What are these?
That's the whole video.
Ey, para hacer la